In this video we're going to explain to you everything you need to know about buy-to-let mortgages. Yes, leverage is one of the most powerful things about being a property investor. But there's so much more to choosing the right mortgage than just looking for the lowest rate. By the end of this video, you'll know exactly what you should be looking for. The first thing you need to know about buy-to-let mortgages is whether you can qualify for one. It is a lot easier if you're a homeowner already or if you've already got a buy-to-let. But if you're starting from scratch, you don't own any properties at all. It's more difficult, but it's not impossible. Unlike a mortgage for your own home, it's not so much about you. Your credit history and your income is still a factor. But the amount that you can borrow isn't based on your income like a residential mortgage is. Instead, it's based on the property. So how much can you borrow? Well, generally most people get 75% loan to value, which is 75% of the purchase price of the property in the form of a mortgage. The other thing you have to take into consideration is the rent. You can't just buy any property and expect to get a maximum loan to value. The lenders will assess the rental levels expected on your particular property. So when you get your property valued, they will also put an expected value on the rent. That number will determine how much you can borrow. This is sometimes referred to as rental stress tests. The quickest way to check if your property you're looking to get a mortgage on will meet the right rental levels is to speak to a mortgage broker, as they will be able to quickly work it out for you. A big decision that you'll need to make when it comes to getting a buy-to-let mortgage is, do you go for an interest-only mortgage or do you repay the capital? Now, most investors choose to only pay off the interest because that leaves you with more cash left over each month. What that means is you get to the end of the mortgage term and you still owe as much as you did in the first place because you haven't been paying it off as you go along. So when you do get to the end of the mortgage term, you'll need to either sell the property to pay the lender back or sell some other assets instead. Now, at first, investors have a really hard time getting their head around this. This sounds really dangerous. You've got this debt that's sitting there and it's not getting any lower. But remember, a mortgage term is normally about 25 years, but you can't keep on remortgaging. So actually, the date of having to repay that debt gets further and further into the future. It can end up being decades away, and in that time inflation will mean that the real value of that debt will have drastically eroded. This explains how you can combine leverage and inflation to really make good use of that debt and have it work for you, not against you. So that's the choice that most investors end up making. But you don't have to if you're more comfortable paying off the capital. So by the end of the mortgage term you're mortgage-free. That's absolutely fine. That's a personal choice that you can make. You may hear people talking about investing through a limited company, and many people choose to do that because of the tax advantages it may give you. The good news is, if you do end up investing through a limited company, the amount of mortgages available to you are actually now very common. As more and more property investors are choosing this route, it's important to note that you will be personally liable for repaying the mortgage, and they still will credit check you because the company is unlikely to have any history. Now, because there's a company involved, the paperwork does take a little bit longer. So make sure you factor that in when purchasing a buy-to-let. So you've made sure that you qualify for a buy-to-let mortgage. You've chosen whether you want to go interest-only or capital repayment, and you've decided if you want to buy a limited company. Now, how do you choose which specific mortgage product is right for you? Well, there's a lot of factors to think about. An important one is the type of mortgage, which is normally expressed in terms of how the interest rate is set. So some common terms you'll have heard are fixed, tracker, and variable. A fixed-rate mortgage is one where, as the name suggests, the interest rate you pay is fixed for a period of time, and normally that's 2 years, 3 years, 5 years, or very occasionally even 10 years. An alternative to fixed is a tracker rate, which means that it changes in line with the Bank of England's base rate. So you might have a mortgage which is priced at 1% above base. So if the base rate goes up from 0.5% to 1%, then your mortgage goes up from 1.5% to 2%. And a third option is just variable, which means the lender can basically change the interest rate to whatever they want, whenever they want. And that's often what you default onto when you come to the end of a fixed or tracker term. That's one of the most important things to look at, as of course is the interest rate. The interest rate determines basically the cost of renting this money from the lender. So of course it's one of the most important things to look at. You're going to want that interest rate to be as low as you can possibly get. These are the points that people often focus on, and quite rightly. But the important thing is to realize there's a lot more to think about as well. Yes, while the headline rates may be very attractive, something else you really need to take into consideration is the fees and costs that surround your mortgage. Some mortgage products will have no fees, and that's great, but others will have fees that run into thousands of pounds. So while some products look more attractive because of their headline rate, when you break down the costs involved, they will actually work out more expensive. But it's not just cost that you need to take into consideration. When choosing a buy-to-let mortgage, you have to consider the speed that your mortgage will go through. And not all lenders are created equal, and their service levels will vary dramatically. This is particularly important if you are getting a deal where you need to move quickly. If you pick the wrong product and it drags on for weeks and sometimes months, that deal may fall apart because of the length of time it's taking you to get a mortgage. And the thing that most people fail to take into consideration is the lending criteria. You personally may qualify for the mortgage that you're going for, but the type of property or where the property is may mean that your application was doomed from the beginning. But you will pay all your costs involved and only find out after time and money has been spent. So it's really important that you check the detail and make sure that you and your property meets the lender's criteria. So because of all of this, the best piece of advice we can give you is work with a mortgage broker. Buy-to-let mortgages are more complex than mortgages on your own home. You need an expert. It could end up costing you time and money if you get it wrong. So as a buy-to-let investor, always work with a mortgage broker. So now you know loads more about buy-to-let mortgages. If you want to take your knowledge even further, subscribe now.